Well, hello, I'm Chris Graw, partner and senior wealth advisor with Carson Wealth. And today I've got Matt Hinz, also senior wealth advisor with Carson Wealth with us. So Matt, good to see you. How are you doing today?
Great to be here.
Very nice. So today we're going to be talking about the value of the advisor. And I think this is a big topic that maybe people don't even think about or understand very much. You know, what is it that brings value to a client relationship that an advisor does for them? And I know, for many people, they think, we pick stocks or bonds or funds or we manage those or whatever. And we certainly do those things, but there's a whole lot more to the relationship than just that. So, the first thing I wanted to talk about today was really what we call behavioral finance. So, you and I have been through quite a bit together over the years as we've been, working together for a good 15 plus years or so. So we've been through 2008, 2020, 22 wasn't a great year, so we've seen a few things in our time.
A little bit.
Talk to us a little bit about, how we work with clients and help work with that behavioral finance aspect.
Yeah, thank you for that. And, looking back over the past 16 years, and you mentioned that you got the housing crisis of '08, you've got the flat, kind of the COVID crash in March of 2020. And then in 2022, kind of a slower burn, but with inflation being what it was, interest rates going up, both stocks and bonds cratered in 2022. And
tough market.
Tough markets. But in all three scenarios, as scary as it is to see the volatility, having the conversations with clients, making sure that their plans still fit, making sure that we've got places to pull money from in a down market to kind of really keep them from making a mistake you can't come back from, which is pulling out in a down market, missing the uptick when markets eventually do recover, is a huge value.
Yeah. So, I think most people know this, but, we've all heard, buy low, sell high, right? Mm-hmm. But, we're almost as human beings wired to do the exact opposite,
Yep.
So, how do you work with people and help them determine, how much risk they should be taking in their portfolio and when should they be doing that, and how does that change over time? Can you talk about that a little bit?
Yeah, absolutely. And I think to speak to that, inherently we know the right thing to do, but emotion's a powerful thing.
Absolutely.
And so when we talk behavioral finance, really it's us being a barrier in large part between clients and their emotions to help them from making a bad decision.
Great point.
But to your point about structuring their portfolios in a way so that we don't make those bad decisions, or we're less likely to make those emotional decisions. Having the conversations with the client on the front end to make sure that we have the right risk profile, the right mix stocks to bonds, and making sure that our safe money is safe in down markets can really help clients avoid making that emotional decision. We saw that a lot in 2022. Markets are down. Clients that had money set on the sidelines to meet their income needs in that year were much less apt to get too worked up and too worried about the drop in the market and inevitably making a bad decision. So that's a big deal.
Yeah, lowering that volatility to match, kind of their expectations is important.
Yep.
Now we deal with that, you kind of talked about the downside of the markets, but we also deal with that on the upside of the markets too, right? We're seeing these, the Magnificent Seven, and now, maybe they're calling them, I don't know, the Magnificent Four or something like that. These stocks, these tech stocks that are just doing, going gangbusters, and everyone wants to jump into these things, and it's very tempting, when you're seeing these stocks go up, 100%, 150% in 1 year. So, we also have to limit, clients getting a little what we might call greedy, right?
Yep.
And trying to get into those. So how do you talk to a client about that when they're, coming to you and they're maybe a more moderate risk investor, but, they're kind of being tempted by short-term returns?
Yeah, FOMO, right? The fear of missing out, especially as markets are going crazy. And over time, we've seen this, especially when we had low interest rate environments. And, our industry, we call this asset creep, when stocks are going through the risk, going through the roof. There's more of an appetite for risk when you haven't seen the volatility for a while. I think about Warren Buffett, who famously said, and I got to cheat here to make sure I get it right, but be fearful when others are greedy, and only be greedy when others are fearful.
Yeah, great quote.
It's a great quote, and really, what are we talking about there? But the whole buy low, sell high, and as we see stocks going up like crazy around us, as you see Nvidia up 400% or whatever it is on any given day, you go, boy, I missed out on that, but might not be the time to jump in. So getting back to what risk are we willing to take to meet our goals, and making sure that we stay true to that.
Yeah. Yeah, great advice. And I think there's something to creating consistent returns
Correct.
over a long period of time. And, yes, we've had clients that have bought NVIDIA or Tesla or Apple when it was, the share price was super low. And that's great, but it's hard to buy and sell stocks on the short term and create consistent returns over a really long period of time, over a lifetime, and that's really what we're all about. So
yeah, as we're at the time we're filming this, moving into baseball season, and I often use the analogy that with your core dollars, the dollars that you plan to live on, that you can't afford to lose, let us hit singles and doubles with those. That's really what we're going for. A home run's great, but we can't afford to strike out. So those consistent returns are kind of what we call the singles and doubles.
Yeah, absolutely. And oftentimes we see those home runs are things that, clients are doing outside of our relationship with them, right? A lot of times they're growing a business that they eventually sell and exit from, or, they get in on a real estate deal or something of that nature where you do hit that home run. But I think having those core dollars allows you to maybe take some more risk and maybe get that triple or maybe even the home run, right?
Exactly.
Yeah. Well, very good. Well, let's shift gears. Let's talk tax a little bit. We deal with a lot of tax planning, and tax efficiency is a big deal when it comes to managing portfolios, both in the what we call qualified assets, such as 401ks, IRAs, Roth IRAs, and the non-qualified side, which would be things like individual accounts or trust accounts or non-retirement assets. So, I know one of the things that very few people have a good understanding of is when you have mutual funds inside of an IRA or 401k, really not a big deal, because that tax shelter, the 401k or IRA, kind of shelters any of those capital gains or dividend distributions and whatnot from tax. But it's kind of a big deal when those are held in a non-qualified account and someone's in a higher tax bracket. So can you talk a little bit about why mutual funds are inefficient from a tax standpoint in a non-qualified account?
I would love to. It's one of my favorite topics. It's kind of nerdy, but yeah. We teach a retirement class, and people's eyes always get wide when we say one of our favorite aspects of financial planning is taxes, because it's something we can kind of control a little bit by making wise decisions. And frankly, I always spend majority of our time. To your question about mutual funds, especially actively managed mutual funds and non-qualified accounts, the way that works is when you buy a mutual fund, you are an owner of that fund pro rata, and you get to participate in the gains when there are some. But also when the fund manager sells assets, highly appreciated assets in a mutual fund, you also get a share in the tax burden of that pro rata. And so over time, we hope you are able to accumulate a lot of dollars in non-qualified accounts or investment accounts outside your retirement accounts. And that's a great thing. But doing so tax efficiently is important. So we've had people come to us with fairly large non-qualified portfolios with actively managed mutual funds. And unbeknownst to them, at the end of the year when they're doing their taxes and they get capital gains distributions from these actively managed mutual funds, sometimes we've seen them into the six figures. Those are large tax bills, and it's nothing more than just having held the fund, not even selling it. And so making sure that you're careful with what you select in non-qualified accounts to mitigate the tax ramifications is a big deal, and over time can have a a big effect on your overall balance in your accounts.
Yeah, absolutely. And I know we both have stories of clients that have come into us who have been, maybe doing it themselves or working with another advisor, and they just don't understand why their tax bill is so high. And, we do kind of, we look at the returns and there it is, capital gains, right? And that can really pop you up into a few more tax brackets. And, we've been able to be successful in working with those clients to, create probably over a 2 to 3 year period where we can really get those capital gains down by choosing some different strategies, whether that be using more indexing in ETFs or individual stocks, maybe even, from a bond standpoint, bond ladders or even muni bonds, if that's appropriate. But, that's something that I think our firm is really, really known for, throughout the community. So talk a little bit about income distribution planning, Matt. So, I've saved all this money for retirement. I'm ready to start enjoying it and taking money out of these buckets that I've accumulated wealth in. How do I choose what bucket I start taking money from? How does that affect me from a tax standpoint? And how do you work with clients to kind of decide those things?
Yeah, great question. You mentioned a little bit there, the bucketing strategy. So as clients are getting close to retirement or in retirement, having dollars that aren't going to be affected or depreciated if we see market volatility is important. And why is that important? It allows the longer term dollars time to grow and allows us not to change strategy in a volatile market. One, beyond that, we do spend a lot of time working with clients, looking at their tax returns and then projecting out where they're going to fall in the tax brackets. And so we want to fill up the bottom tax brackets. We never want to pay zero tax. We don't want to lose those 10 and 12% brackets. Those are pretty valuable. So we're making sure that we're filling those up with IRA dollars, other taxable dollars. And to the extent they need dollars on above and beyond that, that's where we have those tax efficient strategies in the non-retirement accounts. That's where we have Roth dollars. And really each year we're working with clients to kind of play the tax bracket game and the income distribution game. Also, kind of important to point out that under our current tax law, the rates, which are historically low rates, are set to sunset at the end of 2025. And some people might be surprised when we're telling them, hey, in 2024 and 2025, maybe we realize more taxes in these years because we're going to do so at lower rates. And so tax planning is not just a here and now this year endeavor. It is really a 5, 10, 15, 20 year endeavor. And if you're doing that appropriately, that's where we can save a lot of money in the long term. Yeah,
absolutely. And speaking of tax changes, the other thing that's happening beginning of 2026, right, is the first year is, estate taxes are changing. And so, back in, I think it was 2017 with the Tax Cuts and Jobs Act, the estate tax exemptions doubled. And so, what, one person could give, I think at the time it was $6 million a person without any estate tax, doubled to $12 million a person. And now it's, I think, upwards of $13 million per person. Those we're projecting to come down to maybe back down to $7 million a person a couple years from now. So, especially if you've got, a business that's valuable, or farmland, or some of these things, a lot of people are going to be, caught in that estate tax thing again. And we haven't seen that for quite some time. So.
No, we haven't. And my guess is that over the next couple years, you're going to have a lot of attorneys and accountants extremely busy working through those scenarios. And so we always try to be with our clients proactive and start the planning a couple years out so that when that time comes, we're not caught flat-footed.
Yeah, absolutely. And there's so many different tools we have today that we can use, whether it be certain types of trusts or, I think we'll talk a little bit about charitable giving here in a little bit too, that can help and really minimize that tax impact to the overall family. So
absolutely.
Yeah. So again, along the tax efficiency line, how can charitable giving help with tax efficiency? If somebody, especially in retirement, they don't have income from their wages anymore, but they're wanting to continue to give to charity. What are some of the best ways to do that?
Yeah, great question. A couple ways come to mind. One is if you're 70 and a half, you're eligible for a QCD or a qualified charitable distribution. And so let's say I'm 70 and a half and I have an IRA, and maybe I don't need all those dollars in my IRA, or maybe I enjoy giving to my church and or some other foundations throughout the community or charities throughout the community. If I do that out of my IRA, and those checks are paid directly to those charities, I can give money out of my IRA and I'm not charged income tax on that. So great tax efficient way to give money. One, it also has the added benefit of lowering the balance in my IRA so that in future years, I'm not having required minimum distributions or RMDs high enough where that might inadvertently be pushing me up into higher tax brackets. Again, always coming back to taxes.
Yeah.
A second way that we see clients give is in those non-qualified accounts that we always talk about. If you have highly appreciated stock, so we'd as we talk with tech stocks, right, that have been highly appreciated over the past couple of years, instead of writing a check to charity, instead of writing a check to the church, we've got a lot of clients that might gift those highly appreciated stocks to said church or charity. The church or charity can then turn around, sell those. They won't be charged a tax. You've just gotten rid of some of your tax liability. And so that's a pretty efficient way to do things as well.
Yeah, absolutely. Good advice. So shifting gears here, one of the things we do a lot of work in when it comes to being a helping hand to our clients and, the value we provide is really helping them kind of orchestrate with their other advisors. Because a lot of times the advisors they're working with aren't necessarily always talking, right? So, talk a little bit about how we help manage those relationships and how we can create better outcomes for the client by doing that.
Yeah, that's a great question. And, I guess we try to fancy ourselves as your family's CFO or quarterback if you're more into sports than business. So, really what we can do is we can be the one that brings everybody together. So oftentimes when we're working with clients, we are connecting with their attorneys. If we're talking different tax strategies around tax time, now that we're just coming out of tax season, the amount of times we're reaching out to make sure that attorneys have all of the pertinent information they need to properly file people's taxes is important and a big value to clients. Beyond that, we're also talking with clients about estate planning and to the extent that they might not have an estate plan or know to whom to go, connecting them with good attorneys around the area so that they might get a proper estate plan in place. And then from there, also coordinating to make sure that all the beneficiaries are updated, everything's titled appropriately is a big thing. And then for clients that are selling businesses, both those come into play. If you have a mergers or acquisitions attorney or business attorney that's doing a deal, what are the tax impacts? And so we're constantly in communication with advisors, other advisors that a client may have. And that's very helpful to the client. Also make sure that nothing's lost in translation or kind of the old telephone game.
Yeah. I know we get pretty busy around tax time here. And, one of the things we get busy with is clients calling in or emailing in just saying, do I have all my 1099s? Like, you get all this stuff in the mail, right? And you're just like, I don't know if I have everything to give to my accountant. So oftentimes we'll put an email together with all the PDFs that's just kind of nicely put together for the accountant. I know in the past we have had clients where we've reviewed the returns and maybe like capital gains seemed really off. I know I had a client a few years back where there was a really big capital gain, and I got to thinking, man, we had a lot of capital losses too that year. I'm not sure if that ever got captured. Well, yeah, the attorney never got the other 1099 that had all the losses on it. So, we were able to save the client a few bucks, and that's no one's fault necessarily. It's just, if the accountant doesn't have all the information, then, they can only do so much, right?
Correct.
So,
Yeah.
yeah. Let's talk about when life happens a little bit, because I think the value of having a financial advisor really comes into play when maybe things don't go as planned, or, one of those what ifs happens in life, right? So, one of the things along those lines is, there tends to be in a spousal relationship, one of the spouses, is typically the financial person or the more, detail oriented person, and maybe the other spouse is not so much. And we generally encourage both spouses to come to the meeting, right? We really work hard to do that. Why is that so important?
Yeah, great question. And we see this a lot. Yeah, maybe one spouse isn't quite as financially engaged, whether that be because they might not have as much acumen for it, or they just don't care as much, and the other spouse is taking care of it and they trust them to do so. And to your point, yes, it's great to have both spouses in the meeting, or if one spouse doesn't really care to sit in them, at least every other meeting. And
Sure.
and where that really comes into play is if the spouse is a little bit more financially engaged and knows what's going on, is incapacitated or unfortunately were to pass away, the fact that the other spouse can come to us, we have that relationship with them, and at least at a 30,000-foot view, they have an idea of what's going on and what it is that we're trying to accomplish. Mm-hmm. It takes out an added layer of stress in what's already a very stressful situation.
Yeah.
And there's that trust built in that allows us to say, hey, we got this. You go take care of your family.
Yeah.
We'll make sure you're fine from a financial point of view.
Yeah, a lot of burden taken off the shoulders
Exactly.
there. So, yeah, and kind of goes along with, what happens when someone passes away, right? Mm-hmm. Like, one of the values to an advisor is you're not calling an 800 number to try to get beneficiary distributions out, right? That's something we can manage for people. So talk about that a little bit, if you have anything to add.
Yeah, I would say that as proud as I am of our team and everything we've done to manage people's assets and save them money on taxes and help them, avoid the big bad decision when markets go down. I think the care and the service that we provide for families in the time of need is probably the biggest value add. It's someone there that to make sure that we're taking the stress off of people. You get a real life human being, somebody that somebody you can come down and talk to, and they will walk you through the process and take a lot of that off your plate. So that is, in my opinion, one of the biggest values we provide is taking off that stress, because we've got a great team here in the office that cares deeply about our clients and can really bring everything together and get people their money, get people their accounts, and answer any questions in a very thoughtful, caring manner.
Yeah, absolutely. And we can really cut down the time it takes to get all this done, and I mean, I think everybody can really resonate with this message, because we deal with it too. We're humans, we have families, we have finances, and boy, I just struggle spending, 45 minutes to 60 minutes to more on a phone call, trying to go through the phone tree, trying to get to a human being, and so we're very intentional about that here in our office. And in fact, one of our core values is serve over self. And I think one of the things that means is that, we're here to take care of you. And I always tell clients, when someone calls, a human will pick up, and if you walk in our doors, a human will greet you, Yep. And I think our clients really appreciate that, and it feels very warm and inviting, when they do make that call or do come into the office. So the other thing we do is kind of along the insurance lines, right? We've had experiences where, whether we did the insurance or someone else did the insurance, whether it be someone passed away, they've got a disability claim or a long-term care claim, trying to deal with an insurance company isn't always an easy task, right? So
Correct.
Not alone, yes. Let alone trying to get to a human again, but, then trying to figure out, what are the right questions to ask? And, I think a little bit too, am I being told the right things, So talk a little bit about how we deal with that.
Yeah, I've dealt with this recently with a client where we were filing a long-term care claim, and the questions that they ask, and it was a highly stressful situation. So being on the phone with the clients to help them through that process, I could jump in and help them ask the right questions, get the right answers, and then when told one thing that might not sound entirely correct, pushing back to make sure that we get what the client was entitled to. And so that's a good feeling. And I know that it takes a lot of stress off of a client. Much as I don't know how to build a house and I wouldn't even know where to start. Most people don't know insurance contracts in and out. And so that can be kind of a daunting experience.
Yeah. Yeah, absolutely. Yeah. And trying to get some clarity around, I think it can get a little muddy when you're talking to, even if it's just the first person you get on the phone, that might not even be the right person you need to be talking to, right? So getting to that right person and trying to get that figured out. But, well, Matt, this has been great. A lot of fun.
Yeah.
Thanks for doing this. And anything else you want to add or?
No, I think that pretty much sums it up.
Yeah.
A lot of different parts. It's a lot more complex than just picking stocks and bonds. So and a lot more interesting. For that matter. Yeah.
Yeah, absolutely. All right. Well, thanks everybody for joining us, and we'll see you next time.
Thanks.